Hello traders, and welcome back to the ComLucro channel. In today's chapter of our course, Technical Analysis for Day Traders, from basics to advanced, we're diving into one of the foundational concepts of trading, supply and demand zones. Understanding supply and demand zones is crucial for gaining a competitive edge in the financial markets, as these areas often represent significant price movements driven by institutional trading activity. In today's video, part of our supply and demand chapter, we'll explore how these zones are formed, why they hold so much weight in technical analysis, and how to effectively identify them on your charts. We'll walk you through the key concepts, recognizing imbalances, understanding market structure, and spotting liquidity traps, all while applying multi-timeframe analysis for a complete view of market behavior. This lesson is packed with advanced techniques to help refine your entries and exits, giving you the confidence to take full advantage of supply and demand dynamics. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Now let's jump into how supply and demand zones form, how they can signal potential turning points, and how to use them to your advantage in any market condition. Combining technical analysis with a solid understanding of market fundamentals can provide you with a more well-rounded view of potential price movements. Now, let's begin by defining what supply and demand zones are. In classical technical analysis, a demand zone is an area on the chart where significant buying has previously occurred, causing the price to rally, while a supply zone is where selling pressure has led to a price drop. These zones are typically identified by previous highs and lows or areas of high trading volume, and they act as psychological levels where traders anticipate potential price reversals or continuations. However, here at ComLucro, we've refined these concepts to better suit the needs of day traders, making them more practical and effective for shorter-term strategies. First, we classify supply and demand zones into three types based on market structure: order blocks, order flows, and consolidation areas. Order blocks are optimized supply and demand areas with aggressive buying and clear fair value gaps leading to a break of structure. The latest candle creating the fair value gaps is marked, and the liquidity sweep below this candle is noted before the price takes off. When placing a buy limit at this order block, the stop loss should be below the wick where the movement started, incorporating this area into the order block zone as the price corrects. We enter positions when trading opportunities arise. If the last candle creates inefficiency, we place the stop above the swing high for protection, expanding our trading zone and stop. Sometimes, order blocks form with opposite color candles in the midst of heavy movement, utilized by institutions and big players to fill remaining orders. We consider these order blocks and look for trading opportunities upon the price's return to these levels. Next, let's discuss the second type of supply and demand zone, order flow. Order flow represents areas where buying or selling pressure built up before an aggressive market movement. The bullish order flow is where the last bearish pressure occurred before the bullish move, and vice versa for bearish order flow. These areas are crucial in smart money concepts. For example, a move creating fair value gaps and breaking structure includes the last bearish momentum before a drastic move, forming a large zone often containing an order block. Monitoring market structure closely is vital for optimal trade execution. Finally, consolidation areas are key supply and demand zones. These occur when buyers and sellers lack the strength to drive the market into a trend, causing the price to oscillate within a range. Liquidity accumulates, eventually leading to a breakout. Consolidation zones become crucial supply or demand areas for traders, provided there is an imbalance. For instance, if the price consolidates during the Asian session and London liquidity enters, this consolidation zone becomes an ideal demand zone for long opportunities. The stop is protected above the zone with multiple targets set. Similar to order flow areas, consolidation zones can be large, requiring careful trade entry to avoid extensive stop loss. Now let's explore some techniques to enter trades at better prices. We aim for trades with at least a 1 to 2 risk to reward ratio before reaching the first target, usually the latest high. Setting entry at the start of the order block and placing the stop below the swing low provides breathing room for the price. For larger order blocks, position the stop below the zone's end. Two entry techniques are useful for large order flow or consolidation zones. First, enter at the middle of the zone with the stop below, reducing the stop by significant pips. This optimizes entry and exit points. Second, wait for confirmations in lower timeframes, our preferred method, since even strong trading zones might break. We've covered various lower timeframe entry techniques, like change of character entry or retracement levels. When the trading zone is large, we require more confirmations, as the market tends to take out early buyers and sellers. Entering a large demand or supply zone often results in false signals before reversal. Hence, double confirmation is necessary. After a change of character in a downtrend, if the price breaks previous market structure highs, indicating possible reversal, we look for rejections from the recent demand area. If false, the market continues lower. Double confirmation involves waiting for the price to break the new high and form a new structure level, ensuring the change of character and structure continuation. In addition to the traditional classifications, such as order blocks, order flow, and consolidation areas, we apply three essential criteria to more accurately define key supply and demand zones, especially for short-term trading. First, the zone must create a visible imbalance between buying and selling pressure. Next, it must lead to a clear break of a previous market structure level. Finally, it must either generate new liquidity or capture existing liquidity in that area. By focusing on these three criteria, we identify the most important supply and demand zones. Zones that meet these standards are treated as key areas, while those that don't are considered minor or internal structures. Imbalance, inefficiency, and fair value gaps are closely related concepts. When smart money enters the market, it creates an imbalance between buyers and sellers, resulting in significant price movements and gaps between the wicks. In this situation, the price is buy-side inefficient, leading to the formation of fair value gaps between the wicks. A fair value gap occurs in a three-candlestick pattern, where the wicks do not overlap. It's important to note that fair value gaps aren't just isolated to small time frames. They can appear across all time frames. Identifying them on higher time frames, such as the daily or 4-hour chart, can give you a clearer picture of longer-term market trends and add additional weight to potential trading opportunities. Here, we can observe examples of both efficient and inefficient prices. In the second example, the wicks meet in the middle, meaning there are no fair value gaps or inefficiencies. So, how can we use this information to our advantage? When the price makes a significant move and leaves fair value gaps, it often returns to these areas to fill the gaps and restore balance. By combining this with the supply and demand concept, we can identify potential trading opportunities. In this next example, the price is trending upward. In this region, fair value gaps have formed, signaling a buy-side imbalance and sell-side inefficiency. Below this imbalance, we find the demand zone, which has contributed to the imbalance. Now, imagine the price creates another pullback, forming a new demand zone. The key distinction is that the second demand zone lacks imbalance, making it more likely that the price will retrace deeply to the original demand zone that caused the imbalance. This inefficiency acts as a magnet, drawing the price back to fill the gap. In this scenario, our focus will be on the demand or supply zone that generated the imbalance. This zone has a higher likelihood of reversing the price compared to zones formed by more efficient movements. The next key criterion is break of structure or change of character. A supply and demand zone is only valid if it breaks through the structure or the opposing zone. Imagine we have 1, 2, and 3 consecutive moves that break above the previous market structure with imbalance. This confirms a valid demand area. Again, the break of structure combined with imbalance creates another demand zone. If the price revisits this zone, it could present a strong opportunity to go long. However, if the price breaks below the demand level, it signals a change in trend, indicating bearish momentum. In this case, supply has taken over, forming a new supply zone, and we shift to a bearish outlook until the price reaches the next unmitigated demand zone. Once the price hits the demand zone, the directional bias becomes unclear. We need to watch the price action closely to see if the demand level holds. If we see confirmation on the lower timeframes, we can take long positions with reduced risk. But if there's no sign of bullish momentum, we can continue looking for short opportunities. Now, the third criterion, or +1, is the collection of liquidity. This is considered a secondary criterion because it's not essential for creating a valid zone, but it offers strong confirmation. The first two rules, creating imbalance and breaking the structure, are mandatory, while the liquidity sweep simply adds extra validation. When the price forms support levels and internal structures before reaching a demand zone, it increases the chances of bouncing from that zone. This is because these support levels attract traders to buy the asset, and their stop-loss orders become sell orders for smart money. To buy, there must be sellers in the market. This dynamic creates a scenario where the price tends to rebound from the demand zone, with buyers stepping in to capitalize on the perceived value, while sellers' orders are absorbed by buying pressure. In summary, forming liquidity grab patterns within supply and demand zones provides excellent confirmation for short-term market structure shifts. Once these patterns appear, the market often moves toward liquidity zones on the opposite side. But how does a valid liquidity sweep pattern in reversal play out on the chart? Traders should also be aware of false breakouts during liquidity grabs. Often, the market may appear to break a key level, only to reverse soon after. This is why understanding how smart money operates and focusing on liquidity collection patterns can help you avoid being caught in a false breakout and position yourself for stronger, more reliable trades. Before we continue, it's important to highlight that on our channel, we offer a comprehensive course on smart money concepts, where we dive deep into the key principles that drive market movements. We have specific and detailed videos covering all the major smart money concepts, such as fair value gap, order block, break of structure, change of character, liquidity, and much more. Each video is designed to help you understand and apply these concepts in your trading strategies with precision. If you're serious about mastering smart money techniques, make sure to check out this video and explore our complete course to take your trading skills to the next level. Don't miss out on the chance to enhance your knowledge and performance in the markets. Now, let's continue. Imagine that the liquidity is sitting just below the lowest point of this wick. For a valid liquidity sweep pattern, we need to see a pierce through this level and immediately close above the range. Alternatively, one candlestick may close below the line, but the next candle should quickly close back inside the range. This is an early indication that we might see a temporary reversal, at least up to the supply level ahead of the price. If the price breaks and closes above the supply area, it signals a change of character, confirming that the downtrend has ended and a genuine reversal is underway. By combining the change of character with the liquidity sweep pattern, we gain valuable insight into potential future price movements. Now, let me show you some practical examples on a real chart to demonstrate how we analyze market movements and mark supply and demand zones. Here we have the euro-dollar on the 4-hour chart. The market had been in a long-term uptrend until it became exhausted and reversed direction. After breaking below the demand zone, it began forming lower lows and lower highs, indicating we are now in a bearish trend. In this bearish environment, the market consistently creates and respects supply zones, forming what we refer to as a supply chain. Now let's define the market structure and mark the supply zones. As you can see, we have the last high point and low point marked on the chart. The price has broken the structure to the downside with this inefficient move, fulfilling both of our criteria. Afterward, the price pulled back to the supply area and was rejected. At this point, the price is moving within the range of this high and low. Once the price breaks below this market structure level, one of our key criteria will be met. Let's observe what happens next. At this point, the price is broken below the level, creating a new supply zone. This movement has generated an imbalance, leaving a clear fair value gap in this area. We marked the candle that caused the imbalance as our supply zone because we believe that key decisions were made during this candle, right before smart money entered the market. In the next part of the video, we will show you precisely how to mark supply zones in various market conditions. But for now, let's focus on identifying supply and demand zones right here. If the price returns to the supply zone, it could present a strong opportunity to go short. However, if the price breaks above this level, demand would take control. Additionally, we are waiting for the price to break below this low, which would allow us to identify new supply zones. Let's see how this unfolds. As you can see, the price has made another inefficient move to the downside and broken structure. This gives us a new supply area above. Once again, we have an inefficient movement paired with a break of structure, so we mark this as our new supply zone. In this example, we can see a strong downtrend. In such trending markets, pullbacks are typically small, which is why the price often drops before reaching the supply areas. However, in this case, the price tapped into our supply zone and was rejected to the downside, ideally hitting our first target, which would be below this level. Once again, as the price continues to push downward, new supply areas will form, and this process repeats itself. For identifying new supply and demand levels, the key focus of this method revolves around three main concepts: inefficiency, breaks, and liquidity sweeps. Now, let's look at a bullish example. Here we are again on the 4-hour chart, and as you can see, the price is in an uptrend, forming higher highs and higher lows. This was our latest key supply zone, and by breaking above it, we now have a shift in market direction. We can apply the concepts discussed in this video to the chart to identify key demand areas. These demand areas meet the three main criteria: inefficiency, break of structure, and liquidity. Now, let me show you how to mark the correct supply and demand zones in different market scenarios. Imagine we have a market movement showing inefficiency like this. How would you mark your demand area to set a buy limit? As mentioned earlier, the last candle before inefficiency is considered our demand zone because this is where key decisions are made before smart money enters the market. If the price revisits this area, it may reject the price and create a trading opportunity. However, it's important to note that it's not guaranteed that the price will always return to this exact zone and get rejected. In strongly trending markets, small pullbacks often don't reach the marked supply and demand zones, leading to missed trades. On the other hand, in markets with deep retracements, the price might break below the zone before deciding to push higher. The key question here is how to mark your demand area to increase the chances of a high probability trade while avoiding stop-outs and missed trades. One critical factor is the risk-to-reward ratio. If there is a large gap before reaching your first target, you might consider extending your demand zone. Since the exact reversal point is uncertain, adding the candle to your demand zone can still provide a good risk-to-reward ratio with your stop loss safely placed below the swing low. Now, back to refining your zone. You can also include the latest bearish candles in your zone, making the demand area larger. While this decreases your risk-to-reward ratio, you can offset that by zooming into lower time frames when the price reaches the zone to secure a better entry when you receive confirmation. It's impossible to set rigid rules for every scenario, but the essential points to consider when marking your supply and demand zones are the risk-to-reward ratio, stop-loss placement, and retracement levels. Now, let's talk about weak zones. In this example, we have a bullish movement accompanied by inefficiency and a break of structure. The latest candle created the imbalance, so by our default definition, this becomes our demand area. However, we also notice a wick that grabbed liquidity right after the demand candle. Given that we have a strong risk-to-reward ratio, and enough room before hitting the next target, we can extend our demand area to include this wick as well. This adjustment enhances our zone, accounting for the liquidity grab and increasing the chances of the price reacting within this area. In conclusion, mastering supply and demand zones is a crucial element for achieving success in day trading. These zones reveal key areas where institutional traders make impactful moves, offering retail traders the chance to capitalize on these opportunities. By incorporating concepts such as imbalances, break of structure, and liquidity collection, alongside recognizing fair value gaps and wick zones, you can refine your strategies and improve your decision-making. However, identifying these zones is only part of the equation. Pairing this knowledge with a strong understanding of market fundamentals and disciplined risk management will elevate your trading to the next level. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology, because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.